Hello, everyone, and thank you for joining another episode of the Beyond Wall Street podcast. We have another very special guest. Before we introduce our guest, we do want to give a shout out to our sponsor, America's Smart Homes and Businesses. America's Smart Homes and Businesses is serving the Texas areas, surrounding areas of San Antonio, Houston, and Dallas with your air conditioning needs using predictive analytics and artificial intelligence to find the problem before you feel the problem. Okay, today we have Jamie Self from Greystar. Jamie, thank you for being on the podcast today.
Of course. Thanks for having me.
Absolutely excited to get into today's questions. And for our new listeners, what this podcast is all about is we have operators, we have investors, we have business owners, and we're coming together. People are sharing their stories, sharing ideas, sharing lessons learned, and uh, and just growing together. So, Jamie, just so our listeners get to know you a little bit, could you share your background?
Of course. I've worked in some capacity of multifamily property management for the last 20 years. My last 13 years have been with Greystar. I have worked on the operations side as well as the construction side and am currently a operator leader within Greystar.
Very good, very good. And and tell me if this is outside of your wheelhouse. Um, so you have ground up new construction developments, right? That you've had some
Correct.
experience in the past, and then you also have existing properties. Um, what are some of the do you get involved much in the decision making of deciding, or have you seen the decision making deciding whether to do a ground up development or acquire an existing facility? Have you seen much of that, or is that
Yeah, so it's definitely shifted, I would say, a lot over the last, 2 to 3 years. We've seen kind of a saturation of new development. I'm in the Dallas area, but I know that, we've kind of seen that boom throughout Texas and Austin, Houston, and Dallas. I have started seeing a little bit of a shift in the market where, you still have that new development going, but really are starting to see some value add come back to the market. It kind of went away after COVID, but now we're starting to see all of those transactions within our wheelhouse, and we're having them come and buy those properties and really new develop them. But the existing site, so a lot of value add, a lot of renovations, and starting to see that in the market again.
that's a good point you made there with the saturation of the market because I mean what I'm envisioning, and tell me if this is incorrect. Um, so I know there's a lot of people getting into the multifamily space for good reason, right? It's a great
Right.
it's a great asset to look at. And by the way, for our listeners, we are not giving any type of investment advice. This is purely our personal opinions. Seek professional counsel if you need investment
Of
advice. Okay.
course.
All right. Let's continue with the conversation. Um, so when looking at it, um, so the market's saturated. You have a lot of buyers that are buying apartment complexes. You have a lot of developers that are developing, and when the market's saturated and you have that demand exceeding supply, it seems like prices will go up on those assets, which will require whoever does the acquisition or the development to take on more debt. And then you get into cash flow issues because of that debt. And if you don't have the ability to raise rents or charge higher prices, then it seems like you'd put yourself in a bind. If the market's saturated, it seems like it would be difficult to charge those higher prices.
Right.
Am I on the right track here, or what are your thoughts on that?
Yeah, no, of course. As you mentioned with the saturation of the new development, that's really caused the rents to continue to see some decreases. Year over year for several years, we would see the 3, 4, 5% rent growth in the DFW area specifically. And really, over the last 2 to 3 years, we've seen a lot of stagnant growth. We've even seen some rent inversion where, people are renewing at higher rates than we're leasing today. A lot of concession saturation in the market, which, we haven't really had a lot of that in the DFW area. So, all of that is kind of a fallout, I would say, of a lot of that saturation of that new development in the market.
So if you try to raise your rates, let's say 3%, and the market's not there, the tenants will just they'll just leave. They'll just or residents they'll just
Yeah, they're definitely looking for the next best deal right now because the market is so concession heavy. And so, we have to be very mindful when residents come up for renewal on, where the rents are today because everything's so transparent today too. You don't walk into a leasing office and say, "Hey, what are you renting?" Everybody goes online. So, they're going online, they're looking for the specials, they're looking for the rates, they're shopping them daily. And that definitely causes a lot more competition in the market.
okay, okay. So is there something in the economy? And I know right now we're strictly talking on price. We'll get to value here in a second. Um, but purely looking at this price point, is there something in the economy that would cause this to shift, like interest rates, or I mean, what would it take for it to go back to where you can charge those higher rents and that sort of thing?
Yeah, I think, there's a lot of different factors. Inflation is a big buzzword today. When you see the inflation of gas prices and groceries and just the overall cost of living, that the everyday renter really has to tighten their belt. A lot of them are living paycheck to paycheck, and so they don't have a lot of extra. So it's really hard to pay those increases, and so you start to see them shopping around for those deals and for those lower rates to be able to compensate for their lifestyle. Yes, you also see interest rates that definitely dictate a lot in the market. That also causes a lot of transactions to slow down in the multifamily space. You're not seeing as many deals hit the market. You see a lot more kind of under the table deals versus a lot of showcasing and those hitting the market and buyer shopping. And you also really just overall, I think that it's just still we're still absorbing all of that new development. You have to go all the way back to COVID, right? During COVID, there was a halt on a lot of construction. People couldn't get parts. You couldn't get materials, permits. A lot of cities shut down permitting. And so all the stuff that was in the pipeline, there was a huge pause button that was hit. And your multifamily new development may take 2 to 4 years to build, and so putting a pause button on that for about 2 years really caused all that pipeline to hit at the same time. And so we're at the tail end, I think, of absorbing a lot of that pipeline that was really put on pause during COVID, which has caused even an additional increase of the supply that we have in the market.
Okay. So are you optimistic in the next 12 months, or do you still feel like this is going to drag on a little while?
I think that, we definitely could use to see some shifting overall in just some relief at the gas prices and cost of living and all the things will help the everyday renter. But that set aside, I think because of a lot of that new pipeline, a lot of that new development has been absorbed, we're very optimistic for the next, 12 to 18 months. I don't know that we'll ever see, the rent growth that we had in 2022, kind of that post-COVID era where you didn't have all that development hitting because it wasn't ready yet. So we definitely saw that huge bubble in 2022, 2023, and we've kind of been in decline ever since. But very optimistic about the rest of 2026, 2027, and really feel like things will start picking back up in 2028.
Got it. Okay. Okay. So tying all this together, so we got asset prices that are higher, we got debt rates that are higher, which affect cash flow of the properties, and then you got the inflation that affects your ability to raise rents, which makes things tighter for uh, complex owners, property managers, and of course the tenants because they're watching their budget because everyone else is raising their prices. Even in the air conditioning industry, we got notified by a manufacturer earlier this week. They're going to raise all their prices 7%, right? Um, and if you think about the net profit margins on a typical company, that's a big chunk right there if you're going to try to keep prices the same. So definitely, I think we're all feeling it. But let's talk about value add because we got price, and obviously, if everyone's just competing on price, it's a race to the bottom. And so we have to differentiate ourselves in different ways to stand out in the market. Are you seeing any trends or patterns when it comes to value add in the multifamily space?
We are. So really, again, kind of going back to that pipeline, a lot of, as that began to hit the market, a lot of value add just kind of dropped off. Value add was really big 2018, 2019, even into 2020, and then we really saw that halt. Um, with all of the saturation and the prices, we've continued to see a pause there. However, I will say we're starting to see the trend to start to pick up. We're seeing a lot of just needed value add at this point, common spaces, amenity spaces, all the roofing and all the fun, the non-fun stuff, air conditioning. See a lot of that hitting the market right now. Not so much your cosmetic value add, your interiors, your countertops, all of that. However, I do see a pretty good pipeline of that as well. I think that as the saturation of all this new product is absorbed, there's going to put some pressure on your stabilized and your older assets to compete with a lot of that new development that hit the market. And so I think we're going to start to see that traditional renovation value add program pick back up in 2027 and 2028.
So when you're saying value add, you're talking about like upgrades to the complex, kind of like granite countertops, wood floors, appliances, that sort of thing.
From the interior, yeah. So you have obviously, value add on your exterior of your building and the infrastructure of the building, but also, yes, the unit interiors. And that's where we've really seen a big pause because everyone is trying to kind of keep those rates low, and you're not really seeing the ROI in the market for an interior renovation. But I do see that, potentially coming back in 27, 28 as, lenders start lending the money again, interest rates come down, and you start to see that repositioning of assets in the market again.
Have you seen, and I've seen this on condos, I'm sure you have too, where they have like a restaurant and a bar right there. Uh,
Hmm.
do many apartment complexes do that as well, where they have a place to eat and have a drink?
Yes, yeah, you definitely see that in kind of your urban developments, a lot of commercial space, shared mixed use space. I have seen that a lot within in the new developments, I would say within the last 3 to 5 years, seeing that mixed use space. But yeah, definitely a big for some of our urban developments.
Because it seems like if people if their pocketbooks, for lack of a better word, are being constrained by gas and prices and that
Hmm.
sort of thing, if they don't have to drive anywhere, and it seems like, if there's a restaurant right there and there's a bar or whatever, then that's a way to help with some of the cash flow or profitability.
Yes. Oh, of course.
Yeah.
Yeah, we've also started, kind of on that note, another very big popular, I would say, value add to a lot of properties that are stabilized that maybe don't have the option to kind of build that into the infrastructure are, what I would say those little mini markets that you
Oh
see
yeah.
at hotels or, different spaces. And so we've started to add those into a lot of our urban spaces. And they can get quite detailed. We've got one vendor we work with that will do a whole freezer section. They'll do laundry soaps and, different things that residents use on a regular basis. And we've seen that to be a high demand amenity right now, kind of referencing, having better walkability and, less driving and all of the things.
So when a complex has those types of amenities, whether it be a store or restaurant or bar or whatever, do they hire staff to run those things, or do they just lease out that space to those businesses? What have you seen as far as what the economics look like around that?
Yeah, so actually, most of those mini markets that they have are actually they have cameras and they have kind of the self checkout, so you don't have to staff them. They're usually managed and maintained by the vendor that actually supplies them. Different vendors sometimes have profit share options. There are vendors that will install it at no charge because they receive the profit off of the sales. So there's a lot of different ways that you can install it, and it's many times it's a low to no cost to the ownership, but a huge perk and amenity to the residents.
That's so cool. And this is what excites me about these conversations is they're like little micro economies, It's like you got it all right there. Um, and it's funny, now that we're talking, I heard, I don't remember where it was. It was an architect that was talking about this like over 10 years ago about how this is going to be the future and this is what's going to happen. And
Future is here.
yeah, 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 it sure is. Wow, it's going to be interesting to see how things evolve over the next, 12, 24 months or into the future. Pretty soon, people will be able to just stay on the moon, right? They'll just build a
Yeah.
complex right there on the moon.
Well, that's in the multifamily space. That's the name of the game is, downsizing on-site staff and how, we can manage properties from kind of a touchless standpoint, going back to the COVID days. We learned a lot on the fly. So, self-guided tours and, the mini markets where the residents check themselves out. And there's just so many things now that we can do independently. And going back to, how do we decrease the expense and how do we decrease operating expenses at the property with these, 7% hikes on goods and products. I think that is going to be the future. The future is, being able to downsize and have the independent resident that can facilitate those items on their own.
Makes sense. And I know we're running short on time, but last question here. It seems like a lot of data analysis would need to go into play with these things, with the online tours, the clicks and the views and decisions that are being made online. What does that look like from a data analysis standpoint? Is that do complexes typically have somebody on hand? Do they have third parties that come in? I mean, what does that typically look like?
Yeah, so every property is a little bit different. Obviously, we rely a lot on the data analysis just of our PMS system, our marketing systems that give us, monthly and quarterly reporting. We definitely take in consideration the demographic. And probably the biggest decision is your competitors. What are your comps doing? If you have a prospect that's going to come look at your property, they're probably going to look at your top two or three comps. And so, we want to be different, but we want to be better, and we don't want to be offering something that's not working at the
Right.
comps.
Yeah, yeah, that makes sense. Yeah, the voice of the customer, making sure if you are going to spend, an investment on something else for the clients that they actually want it. Yeah, that makes sense. Okay. Well, awesome. Thank you, Jamie. Thanks for coming on the
Yeah, of
podcast.
course. Thanks for having me.
Any last thoughts before we close out?
No, I just appreciate the time and look forward to the rent increasing over the next 2 to 3 years. So hopefully all of the models that point to that are accurate. So
Yeah, that's such a great point because when rents do increase, and a lot of people don't think about it, that gives the property owners and property managers the ability to make investments to have nicer facilities and have more amenities and have those things, and live in a space where people can really feel comfortable and proud of where they live. So thank you so much,
of
Jamie,
course.
and thank you to our listeners. Thank you, Jamie. Thank you to our listeners. Before we close out, we do want to give one final shout out to our sponsor, America's Smart Homes and Businesses. If you want to check out their website, it's ashandb.com, ashandb.com, ashandb.com. They do air conditioning for multifamily and for single family residences and some light commercial, and they use predictive analytics and artificial intelligence to find the problem before they feel the problem. So thank you to our sponsor, and thank you for those that have been tuning in, and stay tuned for future episodes of the Beyond Wall Street podcast.